On January 30, 2026, the prices of gold and silver fell sharply following the announcement that President Donald Trump had selected Kevin Warsh as the next Federal Reserve Chair. This news had an immediate impact on financial markets, particularly on precious metals, which had been experiencing strong gains in recent months due to inflation concerns, global uncertainty, and expectations of continued monetary easing. Investors had turned to gold and silver as safe haven assets, pushing prices to historic highs, but the nomination of Warsh triggered a sell-off as markets reacted to potential changes in monetary policy. Gold and silver had been on a strong upward trajectory, fueled by fears of a weaker US dollar and concerns about inflation. Traders were expecting further gains as central banks pursued loose monetary policies to support economic growth. Warsh's nomination, however, was interpreted as a signal that the Federal Reserve might maintain a more independent and measured approach, which reassured investors about the stability of the dollar. This perception caused a sharp decline in demand for non-yielding assets like precious metals, resulting in steep price drops. Silver prices were particularly hard hit, plummeting by roughly 30% in one of the largest single-day declines in decades. Gold also fell significantly, dropping around 10 to 12%, marking one of its worst trading sessions in recent history. Futures markets mirrored these losses, with leveraged positions in both metals being forced to unwind as traders rushed to minimize risk. The main driver behind the declines was the strengthening US dollar. When the dollar rises, gold and silver, which are priced in dollars, become more expensive for international buyers. Warsh's expected leadership at the Fed was seen as likely to support the dollar and reduce the likelihood of aggressive interest rate cuts, which further diminished the appeal of precious metals as alternative investments. This sharp sell-off also affected related sectors, including mining companies and exchange-traded funds linked to metals, as the value of underlying holdings dropped. Analysts noted that part of the decline was technical, with leveraged traders and speculative investors being forced to sell positions due to margin calls. Despite the short-term losses, many experts emphasize that the long-term fundamentals for gold and silver remain solid. Factors such as ongoing inflationary pressures, geopolitical uncertainty, and industrial demand, including electronics and renewable energy, continue to support these metals over time. The broader financial markets also felt the effects of the announcement. Major stock indexes, including the S&P 500, Dow Jones Industrial Average, and Nasdaq, experienced declines as investors reassessed monetary policy expectations. Currency markets saw the dollar strengthen further, influencing multiple asset classes and highlighting the interconnectedness of global financial markets. Overall, the sharp declines in gold and silver on January 30 highlight how sensitive commodity markets are to Federal Reserve leadership changes. While the sudden drop was painful for investors betting on rising prices, it underscores how central bank policies, expectations for interest rates, and currency strength can dramatically influence market behavior. Despite the volatility, the long-term outlook for precious metals remains supported by both economic and industrial demand factors, suggesting that these assets could continue to play a key role in diversified investment strategies.